Hello, everyone. Welcome to Genscape's Natural Gas Winter Market Outlook webinar that we're presenting to you today. I am Eric Fell. I'm a Senior Gas Analyst at Genscape, and I'm joined also with Rick Margolin, who's another Senior Gas Analyst at Genscape. And together we're going to walk you through our expectations and outlook for supply, demand, and storage for the upcoming winter. This is a web-only presentation, so there is no dial-in. There are, on this page 2, which I'm going to go to momentarily, there is a question box. If you have questions that you would like to ask, feel free to type a question in and submit it, and it will come out to us via text box, and we will either respond in private email or message over the system, or we'll address it to the audience. And there will be a recording of this webinar that will be made available tomorrow. Thanks again for joining us, and I think now we'll go ahead and jump on to the rest of the presentation. Again, it's a web-only presentation. There is no dial-in via the telephone, and you can ask and submit a question on this screen, page 2 of the presentation that's currently in front of you. The agenda today, we'll talk first about the supply side. Then we'll dive into the various components of demand and exports, and then get into our methodology and how we go about projecting inventories when we talk about supply and demand and the way we do it at Genscape. So starting out with supply, I'm only going to present on one slide on supply today. There's a lot of complexity and a lot of components that go into the supply picture. Clearly, prices overall over time are kind of the overarching thing that primarily drive production, being gas prices, oil prices, and NGL prices. And the extent to which those move up and down give producers cash flow, economic incentives to produce and to drill more wells or less wells. And as we've seen, gas and oil prices, although they've rebounded generally through the back half of the year, they've been falling off lately. And clearly those are the kind of price signals that producers ultimately respond to. Economics also change as the efficiencies change and the costs change on the service side. But all else being equal, price is the main sort of driver of rigs and therefore ultimately production. But other things drive production in the U.S. as well. And two of them here on the screen, and they introduce and inject uncertainty into the supply picture, the first of which is ethane rejection. There's a significant amount of ethane that hits the gas stream on any given day. We split up ethane rejection in two pieces. There's an economic ethane rejection component, and then there's some that is quite simply just infrastructure constrained, and therefore they can't strip the ethane out and it has to be sent into the stream. And we saw this summer, sort of late July, early August, a time when ethane prices sort of plummeted, and it suddenly was no longer economic to withdraw the ethane or to extract it from the stream, and so you had a big change in ethane rejection very quickly. And so from just over a few weeks, you had about an extra half a BCF a day of supply that hit the natural gas stream in the form of rejected ethane, and that's something that can change very quickly. The ethane market is much smaller than the U.S. natural gas market, and effectively it uses the natural gas market to balance itself whenever it needs. If it's feeling long supply, then they can change the price and change the dynamics of ethane rejection. The second part of this slide is infrastructure, in particular in the Northeast. So while most of the rest of the country, when you talk about forecasting production, we go about it with traditional models of here are the existing wells that are online. This is what the declines look like of those wells. Here's how many new wells we see coming online to replace or not the declines that are occurring. And if you have enough new gas coming online and more new gas coming online, then you have existing declines, then you have production growth. Conversely, if declines are greater than, or if the new gas coming online is less than your declines, then production is in fact declining in a given time period in a given region or area. And outside of the Northeast, for most of the rest of the country, that's the situation that we're in today, and that production generally outside of the Northeast is in fact declining. The Northeast, however, that whole methodology of predicting production in the Northeast hasn't worked for quite some time, for a number of years, in fact, as the whole Northeast complex has been constrained by takeaway and export capacity, infrastructure of some sort, whether it's regional transport within the Northeast, it's some sort of gathering or processing, or ultimately really the main constraint in the Northeast has been export capacity on the large pipelines. There is a tremendous amount of export capacity that is scheduled or slated to be coming online over the next 12 months to 18 months. However, there is a tremendous risk to many of these projects, primarily with respect to timing, and in some cases possibly with respect to scope. Either the project could get downsized, or maybe it's not actually, in fact, as big as being advertised by the pipeline. So I would say there's serious risk to timing and scope, or size, I would say, of what this chart is showing as sort of an advertised list of export capacity projects, and some big ones that jump off of the page are Rover, 3.2 BCF a day pipeline that's supposed to come online, if you believe ETC, by June of next year. We don't believe that is likely. I think we have the earliest as something like September, if all goes swimmingly well for them and they start construction, they get their permit, and they start very, very soon. But that could easily push into 2018. There's just a lot of uncertainty and risk associated with all of these projects. That one in particular has more than most, but I just highlighted as it's the biggest single project on the board that's supposed to come online in the next 12 months. It shows as a lot of excess capacity and suddenly an unconstrained Northeast, but the reality, I think, is something much less than what that blue line would indicate. So there's a lot of risks there as well, and I just wanted to highlight some of the things that, as an analyst, kind of keep us awake at night in trying to follow things like where are ethane prices, what do they mean for rejection today and going forward. And we have a team of people at Genscape, 3 people that spend their time tracking various infrastructure projects and getting information from FERC filings and from public companies, quarterly reports, those sorts of things, and trying to read the tea leaves and understanding changes to these infrastructure projects and how they will impact the gas markets. So from that, I'm going to move on to the demand side of the equation, and it is election day, and so we had to have Trump somewhere in the presentation. And from winter perspective and from a natural gas perspective, at this time of year, from November through March, winter weather trumps everything. It truly does. The number of HDDs that we accumulate, how cold or mild is the winter, ultimately is the main determinant of how much gas we draw that winter, how much demand that we get, and therefore how much gas that we draw. And then that sort of sets up the whole next year in terms of, are we going to need, if it's a mild winter and we end with storage, in very high amounts of storage at the end of March, then you're going to need continued low prices to get incremental demand in terms of fuel switching and of a supply response potentially, or vice versa. If you have a cold winter like we saw in 13-14, you get higher prices because you are concerned about the future and you want to have less fuel switching and perhaps incentivize more rigs. So winter is upon us. We have had in the last 5 years quite a, not only does winter weather trump everything, but it also, as you can see from this sort of prior 10-year histogram, it can be extremely volatile. I mean, there's 10 and 30-year normals, but then there's a lot of variation around that, and we've had 2 of the mildest winters ever recorded in terms of gas-weighted heating degree days in the last 5 years, and we've also had a kind of a 30-year cold winter in 13-14, and the difference in terms of the demand is extreme. And so ultimately, the direction of the price of natural gas this time of year really depends on the weather, and the whole reason that gas prices have been plummeting over the last couple of weeks is that we're getting off to an incredibly mild start to the winter. Last winter started out extremely mild, but we're actually getting off from what we've actualized the first sort of 8 days of November plus the next 2 weeks forecast that we can currently see or currently predict. It looks like we're starting off even below last year's pace in terms of how mild this November has been, and so you end up in sort of a classic storage containment situation where we're effectively full or mostly full in storage and weather, even though balances look very tight on a weather-adjusted basis, the weather itself trumps that, and it's causing us to continue to inject well into what normally would be withdrawal season at a time when utility storage is full and can't and or won't inject, and so you're increasing your call on the available economic guys, the salt guys, and they're running out of room, as we speak. And so the cash price has to go much lower, and the curve goes into significant contango, and it's just a classic, early winter storage containment driven by very mild start to the winter scenario that has played out, several times over the last 10 years. Moving on to but ResCom's, as we were just is really a function of weather for the most part. Power demand is driven by a variety of things. It's the most sort of complex piece of the demand puzzle, if you will. But so weather drives power to a certain degree. The electric weighted heating degree days drive power loads in the winter. Cooling degree days drive it in the summer. You can have load growth or not, depending on the economic situation and the part of the country that you're in. And you also have changes in the stack. And so we have had ongoing growth of wind and solar, in particular, those two types of renewable generation over the last several years. Every year we keep adding new capacity. Hydroelectric generation changes significantly from year to year based on the water year that we how much water you accumulate over the course of the winter in the west, and then also just precipitation as you go through the year. And 2015 was the driest year we'd had in at least 10 years, and so even though this year was a little bit below normal, it was a big rebound from 2015, and so increased hydro generation in 2016. This Q2, Q3 this summer, was although we had a hot summer and gas prices were slightly lower than last summer, there was significant growth of power burn that was being driven by more heat and lower prices, but there was some offset to that in terms of we had extra hydrogen and extra wind and extra solar gen on a year-on-year basis, and so our summer power gen wasn't quite as strong as one would have maybe expected just because of the extra CDDs that we accumulated and the fact that prices were about 12 cents lower each summer. But when you sort of just look at, if you try to think about fuel switching and you think about it or look at data that's daily or weekly, you can get really cross-eyed because the data gets difficult to sort of follow and to make sense of. But when you step back and look at it on a monthly basis, or even in this case on a summer versus summer basis, some of those weird seasonal factors somewhat balance out. They get muted at least across the summer. So you might have super high hydro output or nuke output in Q2, but then Q3 it's below normal. So some of that stuff kind of balances out over the course of a season to some extent. And what you see is how much over the last 7 summers that if you just plugged in gas prices and nothing else, you could have done gotten fairly close, at least in terms of predicting what the power burn, the gas demand from a power burn perspective would have been. So it is the single biggest driver of power generation demand is in fact just the price of gas and how much that means in terms of fuel switching in the power stack. Something that we watch, and capacity changes matter, changes in generation matter, loads and changes in growth or declines in loads matter. All those things matter, but ultimately the price of gas is the largest determinant of how much gas we're going to consume in the power stack. I'm going to at this point turn this slide over to Rick Margolin, who is the other analyst, senior analyst at Genscape, and he is our Mexico export. So Rick, go ahead.
Yeah, so continuing with the conversation about demand is the volume of gas that the U.S. has been exporting to Mexico. For those that watch this closely, you've known that there's been a pretty significant ramp up in exports to Mexico the past couple of years. This has really been driven by 2 main factors. One is, as you can see on the chart on the left, the growth in intra-Mexican demand. That has itself been fueled by 2 major components. One is fuel switching within Mexico's power stack. That power stack was once pretty heavily dominated by fuel oil, but Mexico has embarked upon switching over to cleaner burning, higher efficiency natural gas. And so that's been a big source of nat gas demand growth within Mexico the past couple of years. And going forward, that should probably continue to show some elements of growth there, as there are still some remnants of fuel oil within the stack that could be converted, but the pace and the rate of growth is probably going to slow down there just because the low-hanging fruit has already been picked off. But the other driver of Mexican demand growth has been the industrial sector. You can see in the chart that growth has not been nearly as large as what has happened in the power sector, but it's still been a significant source of growth for gas demand historically, and we do believe that there are continued prospects for gas demand growth in Mexico's industrial sector. However, really the larger driver of existing export growth as well as future export growth is going to be the ability of U.S. gas to displace Mexican production. So as you can see in the chart on the right, Mexican production from both associated and targeted gas has witnessed some declines. For a long time, that was really driven by some of the operating challenges that have been facing Pemex. But as Mexico embarks to liberalize its energy sector and open the market up to foreign direct investment, part of that is going to feature increased pipeline capacity from the U.S. into Mexico. Right now, pipes flowing gas to Mexico are not constrained. So really the build-out of new pipeline capacity from the U.S. to Mexico, it's not so much to serve growing demand, although we do believe that demand growth is there, but it's really about enabling Mexican consumers to get access to lower cost, higher reliability supply than what they can get now. So as a result, we do see exports this winter running about 4.1 BCF a day or so, which would, if realized, be a gain of about 0.9 BCF a day winter over winter. Right now at Genscape, we estimate that flows are running about 4.3 BCF a day. Oftentimes we hear that that's in excess of market expectations, but with the recent EIA release, we came in just 1.9% above EIA's numbers. And since we began incorporating proprietary data, our error to EIA has been about 3%. And really we believe that the accuracy of our estimates of daily exports to Mexico is because we do have a proprietary monitor on one of the major pipelines, Net Mexico. Since late July, early August, this one pipeline by itself is moving over 50% of total exports to Mexico, and it's not visible to the market. So at Genscape, we have a monitor on that, and that helps with our total Mexico estimates, and that's going to be really important moving forward because as new pipelines get built, these pipelines to move gas into Mexico will not report as interstate pipelines do. So the best way to get an estimate is with proprietary data. And so having that will be really important as we do expect exports to continue growing, not just this winter, but beyond. So let me flip it back over to Eric to continue fleshing out the demand side.
Had to unmute. Thanks, Rick. Appreciate that. Past the Mexican exports, the other component of export scenario and story that has shown amazing growth or is undergoing a significant growth and having big impacts on our market, even bigger impacts going forward really than Mexico, is LNG. And so we now have 2 trains already online from Sabine Pass. We have 2 more that are coming online next year in addition to Cove Point, which is supposed to be online by the end of 17. And there's a significant amount of another 4 BCF beyond that that's already under construction, by the way, scheduled online by Q1 of 2019 according to current schedules. And so what's interesting about that, there's a lot of things interesting about it. I mean, there are people that before the first cargo shipped, kept thinking this would never happen, but it in fact is happening, and these aren't just pie in the sky, maybe going to happen someday. These things are approved. They're already under construction. These aren't just potential projects. There are quite a few more projects out there that are not yet at FID or final investment decision or final approval stage, and that are pending. These are just projects that are approved, financed, have contracts, and are under construction today. And so by the time we get to sort of mid-2000 or early 2019, again, according to current sort of construction schedules, we will have more than 9 BCF a day of LNG export capacity in operation here in the United States. And there's more that could come depending on what else gets approved and financed, and they move forward with Sabine, or Cheniere rather, not just Sabine, but Cheniere is the single largest capacity holder, and they're the ones that have been the first movers and have two projects already online, with 2 more trains online, as I said, for next year. So clearly these LNG exports are happening. The naysayers have been proven clearly wrong on that front. What we don't know is to what extent or the risk, I guess, with respect to this project or with this forecast, is the timing of the projects is sort of the risk number one. So if trains 3 and 4 from Sabine get delayed from their current sort of schedule for some reason, that could push those exports back a few months. Another risk is that the global LNG market becomes saturated or inundated or long LNG, and they don't want all of this LNG, and that could be either due to economic reasons, a downturn in demand. It could be because some of these delayed Australian projects, for example, come online, and between the extra Australian gas and our own increased exports, there's just not enough demand in the short run to sort of take it, and so there can be exports could be below kind of capacity for that reason. But one thing I believe fairly strongly, I mentioned when I began the presentation, is that Genscape, how we model our supply and demand, might be a bit different than how other vendors do it. And one of the things that we do at Genscape is we mark our supply and our demand curves to market-based curves every week. So the forward curves published by the CME every Friday for WTI for crude oil prices, Henry Hub for the various basis points for NBP in this example. And so what I do, I built a sort of theoretical model that takes the spread between the forward price spread between NBP and Henry Hub, and this is actually a little dated. It's even higher than this today in the forwards, but it's in the money is the point. So I didn't feel like it was totally necessary to sort of update this chart just because the price had moved up even further for NBP and down for Henry Hub. The point is that if it is in the money, it should ship, and is very, very likely to ship if we have the operational capacity to do so. If the global LNG market feels long and doesn't want all of this LNG, the price will need to correct. The relative spread will need to correct in order for the LNG to not ship. Let me rephrase that and state that one more time. If the spread is in the money, it's much like there's a lot of gas people on the call, and it's no different really, not much different than a gas pipeline. And if you have transport from out of the Marcellus down to Transco Zone 5, and the Marcellus is trading $1 back at the hub, you're going to utilize that transport on any given day versus a Zone 5 price that's going to be substantially higher. You're going to ignore the sunk cost that you're paying Transco every month for the capacity, and you're going to look at the variable cost versus the marginal prices in the 2 points at which you can buy gas and sell gas, and that's how you will make that decision to ship the gas on that given day. And that's no different than how the LNG market it mostly should play out, and we believe it will play out most of the time. There is more friction involved in the LNG market. Some of these subscribers are kind of utility-based subscribers, if you will, so they might be an Italian or Spanish utility, for example, and so they may not be as price sensitive, and this could just be a supply diversity ploy, or they've bought this stuff in advance and it's sort of already hedged in their mind, and even if it goes out of the money in the theoretical short run, they want the gas anyway, and so it may be that more gas ships that appears not to be economic to sort of an untrained observer, but you can have different sort of incentives when you're talking about which is no different than when you talk about storage or pipeline transport, when you have a sort of an economic marketing type player versus a utility player that maybe just, we always like to use the term, charges back to the ratepayer. And so it may not seem, as efficient or economically optimized as one might think it should be. But in the end, I think most of the volumes as they flow on LNG will will respond and react to a large extent to relative prices. One thing I'll say is, although we have no history of, or very little history at this point, of LNG exports going out of this country from the lower 48 and being responsive to prices, we do have history the other way around. So if you sort of went back in time, back to 2006 and 7, when we had the peak LNG imports, you'll see at that time that NBP prices fell below Henry Hub prices. And what that did was it incentivized cargoes that were coming from, let's say, Yemen or somewhere in the Middle East, as it crossed through the Suez Canal and was sailing through the Mediterranean. Instead of turning right once it sailed through the Straits of Gibraltar and heading up towards the UK or northwestern Europe, it kept sailing west towards the United States, so it could unload a cargo at Elba, Lake Charles, or one of our various LNG terminals that might have taken it. And so we did see back then, 10 years ago, a LNG market that at the time, even though there was less spot, it's more efficient likely today than it was then. We saw then the LNG market respond to price signals in the global markets, and it did in fact shift cargoes, a significant number of cargoes, away from Europe and towards the United States. And so there's no reason to think the converse shouldn't be true. So that's the basis upon which this model is built. It ignores the sunk costs, the $2.25 to $3 that, for example, shippers are paying to Sabine for its capacity, or Cheniere rather, and it just includes the 15% of hub incrementally that it costs them to liquefy, the shipping and port costs, boil off, bunker fuel, etc. It is likely that I'm overestimating these costs as marginal costs, because for many of these shippers, probably most if not all of them, shipping is likely a sunk cost as well. So they don't actually have to go out and charter a boat. I include that as one of the marginal costs, is the boat charter costs, but many of them would already have a fleet of boats that they own or have are contractually obligated to under a long-term agreement. Therefore, that wouldn't actually be considered a sunk cost. So if anything, I'm being too conservative with respect to the marginal costs, but it's moot at this point. It's really just in the money, out the curve, and that would come into play as we see, boats continuing to go when, according to this model, they appear uneconomic. And I think that the answer might be that, okay, well, I'm being too conservative with my view of marginal costs. So that's the basis of this model. It's theoretical. I much prefer, like when I do fuel switching, it's actually observed behavior versus observed prices. I detest theoretical sort of stack-based models. I much prefer as an analyst to use real history and real prices as a gauge of what's likely to happen in the future. But the problem with LNG exports is we just don't have good history of exports out of this country yet. But over time, this will be refined, and hopefully we'll get a better answer on how sensitive this will be to the economics and what those economics are. Industrial growth is the other big component of demand. We have had tremendous growth of industrial demand over the last 5 years. Just looking at the annual numbers from 2010 versus 2015, it's roughly 2 BCF a day of growth. Essentially all of that growth has been either in the petrochemical, or not petrochemical, just chemicals in general. It could be fertilizers, industrial chemicals, inorganic and organic chemicals, and also the refining side of the equation as well. And refining, if you broke chemicals up into its component pieces, those various kind of sub-industries, refining actually is the single biggest user of natural gas. It consumes close to 3 BCF a day of natural gas on any given day. But those have been the two sectors where we have seen the growth. The other sectors have mostly just been static, mostly stagnant over that same time frame. And the reason is it's really a feedstock story. I'll get more into that in a minute, but this really explains a lot of it right here. Natural gas is cheap in this country relative to oil, relative to the rest of the world. And so one of the things that is happening is that we are building things that take advantage of cheap natural gas, cheap NGL prices, and one of the sort of big needle movers, if you will, from a natural gas demand perspective, are ammonia and methanol plants. And these are facilities that can take natural gas as a direct input, a direct feedstock, and convert it into ammonia, and then ammonia in turn can be used as industrial chemical, and in most of these cases it's being converted further from ammonia into a nitrogen-based fertilizer. Methanol can be used for a number of things, including transportation fuels. So these are plants that are on the chart. under construction. The chart on the left is an EIA graphic that shows the proposed plants. My chart, much like the LNG chart that I showed earlier, are plants that are under construction. If I were to have taken this chart all the way out to 2020 and put all the proposed plants on there, the amount of gas burn it would have implied would have been closer to 5 BCF a day by the time you get to 2020. I don't think that any of these plants that are not already under construction are likely to happen in a $40 to $50 crude oil environment. These things are all sort of shelved indefinitely. But the ones that are already under construction, they will go ahead and continue and complete the construction process. And many of these are already online at this point. Like the ammonia, there's a tremendous amount of ammonia capacity coming online in Q4 of this year, or possibly even early Q1 of next year that will add further to the demand scenario on the industrial side. So that's the expansions on the chemical side that are relate to direct feedstocks of converting natural gas into useful end products. There's also another component, and I mentioned refineries just a minute ago, as the single biggest piece of the equation, 3 BCF a day approximately that gets consumed by refineries. This chart doesn't quite get to 3 because this is only the direct fuel. There's also the cogeneration facilities that burn about 600 million a day. So when you add that in, it gets to about 3 BCF a day. But what you can see is that over the last several years, refinery runs have continued to grow, and largely because of the cheap crude oil and the growing crude oil production also in this country. And so as refinery runs have grown, as refinery utilization has grown, you've had to have increased fuels to run those refineries, to run those processes at the refineries. And so natural gas has naturally grown as refinery runs have grown. And so, refinery runs grew around 10% from 2009 to 2014. However, natural gas over that same time frame grew 25%. So another thing that was happening in addition to refinery runs and increased refinery utilization was another form of fuel switching that doesn't get really mentioned or talked about much. We don't have as much data on it, and is not anywhere near as big of a deal as fuel switching in the power stack. However, it does move the needle a bit, and we have seen fuel switching in the refining space where natural gas relative to different forms of LPGs, in particular propane, I understand, is one of the big fuels that gets used on the LPG side, and various forms of distillate resid and other types of crude-related products. Those have declined over that same time frame from 2009 through 13, and then they started to reverse the other way. And in 15 was a big year where some of that fuel switching reversed. And so in 2015, refinery runs grew an additional 2%, but gas consumption at refineries fell 5%. And if you recall, what happened last year, in particular around Q3, is whenever not only crude prices fell, but NGL prices fell really hard. And so, gas was already cheap, but these other fuels fell down towards gas, and so that relative advantage that gas had held over LPGs and distillates went away to a meaningful degree in 2015. And so what we saw was a reversal of some of that fuel switching in the refinery stack. And the other thing that's worth mentioning is that fuel input costs alone don't determine the optimal fuel mix for an integrated refinery and petrochemical complex, because as you switch your fuels going in, it also changes to some extent the outputs that you get and the byproducts. And so there's some very complicated math that I'm not smart enough to do, but clearly the fuel input costs themselves have a meaningful say in terms of what sort of fuel incentives that drive fuel use at refineries. Another piece of the equation on industrial demand, and it's just to sort of drill down a little further, is the metals output, and steel in particular. We consume about a BCF a day in the production of steel in this country. And one of the things that if you were to go look at the annual industrial demand numbers, 2015 was actually down on a little bit on a year-on-year basis, and it didn't show the kind of growth we had been seeing for several years. And there's a couple of reasons for it. One was the previous slide I just showed you, that the fuel switching at the refineries reversed a bit in 2015. There's also a component of industrial demand that is really space heating, and so if you have an auto assembly plant, let's say outside of Detroit, and it might consume 5 million a day all year long to run its processes. But if it gets cold up in Michigan, you'll see the consumption at that plant ramp up to 35 million a day, because it's got to heat the space that its workers are in. You can't freeze your workers if they don't want to come to work. And so it was a mild winter last winter, 2015, that hurt in Q1. It hurt industrial demand because you had fewer HDDs. Another thing that hurt industrial demand last year was a structural decline, a cyclical decline, whatever you want to call it, in steel output. And so steel output in the U.S. fell more than 10%. It fell almost 11% year on year in 2015, back to the lowest levels we've seen since the Great Recession of 08-09. And in fact, 2016 is down slightly. It's down about 1% year on year. And so while it hasn't shown signs of a real rebound just yet, at least through September, it's not this massive year on year headwind. And we're seeing some very real growth in industrial demand as you go through the summer months, and those HDDs don't matter. That structural growth that underlies maybe the fuel switching in the refineries, you continue to have growth in runs, and maybe that gas prices are a little bit cheaper this year through most of 2016 than they looked in Q3 of 15, and then just the ongoing growth of the methanol and the chemical plants and the fertilizer plants that continue to come online is behind the real growth we're seeing in industrial demand. So I think I mentioned a little bit about our forecast process at Genscape. And so when we look at production, for example, we use the CME curves every Friday, and every week we will, as we get new prices and plug them into our models, they imply, okay, less rigs and more rigs. And both crude prices and gas prices and NGL prices, for that matter, drive production, along with our changing assumptions of efficiencies, et cetera. But as prices move, our production forecast moves. If we change our infrastructure assumptions in the Northeast, it can impact our forecast for production, and if our ethane balances change. So our production numbers can change every week. Production is generally not sensitive in the super short run. In other words, it can take 6 months before a change in prices has an impact on, first of all, rigs, and then once that rig is brought online, for example, it takes several months then for the wells to be drilled and completed, because you're going to probably do a whole pad of wells. And so it can be 6 to 9 months before you see a meaningful change in production. But if you start to do balances out over time, those start to matter. Also on the demand side, as forward curves change for natural gas prices, that has significant impact potential on fuel switching demand in the power stack. And so we independently do the assessment of what is the impact of this price on the demand side and the supply side, and we put our supply up against the demand, and that spits out a number for storage. And as one might think, as prices go lower, you get less supply and more demand, your storage outlook should go down, and vice versa. And so what we do is we put in what the question people sometimes you hear asked around the market are, what is quote unquote priced into the market? Well, that's kind of how we think about it is, given current prices, what does that imply for supply? What does it imply for demand? If prices were to stay here and if weather were to be normal, what does that project to? Does it make sense? Is it too low? Is it too high? And so if prices get too high, our storage balances will look too high. If prices get too low, our storage balances will look too low. And we launched a forward-looking storage product in April of this year, and our very first forecast, when you look all the way up to March of 2018, which is not this winter, but even a further winter out, we actually had a negative balance that if prices were to have stayed that low at that point in time, Cal 17 was trading at $2.80 for Henry Hub, and crude oil was $45. When Cal 17 hit $3.40 recently, and crude was at nearly $53, we were at over $1,500 end of season for March of 2018. So there's a big swing that can happen based on price. Of course, as I mentioned before at the beginning of this slide, and as I mentioned here, that assumes normal weather. We're clearly not getting normal weather so far this winter, and so the extent to which weather continues to be milder than normal, then at a given price, your storage balances are creeping up. I don't have any idea what the winter weather is going to be past the next couple of weeks of November. I'm not a weather forecaster. I can just tell you what the weather impacts on a weather-adjusted basis. Things are how they're looking, if they're looking very tight, what the structural setup is, and ultimately, just like everybody else, I have to sort of wait and see what happens in terms of the weather. But you can tell if something is looking like it is more often than not going to be priced too low, too high, et cetera. So anyway, this is, I thought rather than showing you the specific forecast this week, this is the process by which we go through, and I've charted our weekly storage outlook for March of 18 versus both Henry Hub prices and against WTI prices, because as I mentioned before with our production forecast, they both matter. Clearly gas prices matter more than crude oil prices because crude oil prices only impact the supply part of the picture in a meaningful way. It can impact the demand a little bit, but gas prices impact gas production and they impact the demand as it relates to fuel switching, and they can also impact LNG exports potentially. If we were to rally up against NBP, for example, you could there's sort of two ways that LNG exports can go down from a price perspective. Our Henry Hub price can rally up to NBP, or NBP can collapse down onto Henry Hub, or some combination of the two to reduce LNG exports is one of the other levers that we have. If things were to get too tight, you could loosen the market that way. And I also want to just sort of point out that it's one thing to project out March of 18 way out in the future, and a lot of people might discount that. But what happened this summer, and this shows the progression rather of our end of October storage. And I only took this through the end of September because for anybody that was trading October, that's when it goes off the board and it doesn't sort of matter anymore. Clearly our October balances ended up closer to 4 Ts because October weather was tremendously below normal, and that added quite a bit to the end of season tally versus what normal weather would have suggested. But we had an end of season storage outlook for October of this year that had ranged from as high as 4 TCF to as low as 3850. And what I found interesting was that when we were getting into July and even into August, when prices had fallen quite significantly. And so, we had a projection on July 1st, our projection was 39.90, and October Henry Hub was trading 301. Ocjan was at 48 cents. And then on August 12th, so roughly 5-6 weeks later, our end of Oct had fallen to below 38.50, and October Henry Hub had fallen from just over $3 down to $2.63. Ocjan had widened out to 58 cents, and what had been happening was that hot weather and lower gas prices were contributing to much stronger burns and lower injections than people had thought that it would. And so by the middle of August, we had an end of summer forecast that at the time was more than 100 BCF below consensus. I remember there was actually there's a seasonal swap that trades in the market, and the end of Oct swap traded like 39.75 right around when we were below, right around 38.50. So we were more than 100 Bs below the market. Ocjan was close to 60 cents. And our numbers are sort of saying, okay, if prices stay here and if weather just stays normal, not only are we not going to have containment, we're not even going to get to 3.9. And it was a signal to people that subscribe to our forward supply demand outlook product that you have a good opportunity here, or the market's mispricing this containment risk, however you want to sort of think about it. So that is how we go about modeling. We have again a product that gets updated every week with the impact of not only just price, but we put the prices in, but also the near-term weather forecast for the next 2 weeks. We assume normals beyond that. Any changes to the infrastructure, changes to ethane rejection, other sort of assumptions on the supply or demand side that can change from week to week as we get new information. And our assumptions are constantly evolving. The model's never, it's a living, breathing, sort of thing. It's never sort of complete. We're always getting new information. So that's how we go about modeling. I've got about 15 minutes left. I wanted to open it up for Q&A and see what kind of questions we can answer for our audience. And so someone asked the question, where do you get sub $2 liquefaction and transport costs from U.S. Gulf Coast to Europe, considering the lowest toll from Sabine Train 1, the BG contract is $2.25. I think I mentioned this in the presentation. I just like a pipeline transport contract you might have, I consider that to be sunk. So I'm looking at the marginal costs. So the capacity payments that they're making are much like demand fees on a pipeline, and they are a sunk cost, and they don't get, in my view, considered on a day-to-day basis when you're making a decision on the marginal decisions. There's one. is your Mexican export number for summer 17. Rick, do you want to address that?
I think we are looking at in the 4.3 to 4.4 BCF per day range. There's seasonality obviously in that, and so there will be days where we could be flirting with 4.5 BCF per day. There's certainly more capacity that will be coming into the market in Q1 of 17, and another pipeline that comes in Q2. Again, the market's not constrained, so we don't harbor any expectations that this increase of new capacity is going to be anywhere near fully utilized. But what we do expect is that we'll start to see next summer what we kind of started to see this summer, which is a tighter correlation between Mexican temperatures and export flows, and possibly some sort of emerging correlation between prices and flows. Mexican prices are still sort of a black box, but we do know that these increased volumes during the summertime are meant to go serve power loads. So yeah, so we'll be in the 4.3, 4.4 BCF per day range, again with days that get up into the 4 or 5 range.
Thanks, Rick. I've got a couple questions on what actually is our March 2017 estimate at current prices. So our March 17 at sort of current 14-day weather, normals thereafter, and these are prices as of Friday. They've actually come down a bit since then, but 1643 would be our number for March of 17 at prices marked to market on Friday and kind of current near-term weather. Another question says the LNG export forecast looks like an if they build it, they will come. Up to what LNG export capacity do you think this holds true? So we use the forward curves in this case. We don't force our models to sort of say something reasonable. So based on what is under construction today and the current sort of construction timeline, which actually looks reasonable, I don't think there's any reason to think that these LNG capacity projects are majorly delayed. Then it really just a function of the willingness and the price of the markets to take the gas. And so I'm not trying to project a global LNG balance. I'm simply saying that if global prices, and I use NBP to sort of represent that, it's a sort of very freight logical near-term market. Most of our exports have actually gone to a better netback to South America, but you can use the European market as a large liquid market that does take a lot of LNG, and so you can use that and it's a liquid point with a reasonable forward price that you can rely on. It's very volatile; it can change, but at current forward prices, it's in the money. It will ship if we have the capacity available. And if BG and Shell don't ship it themselves, if it's in the money, Cheniere will ship it. They have the last sort of right to ship the gas. So it's not just entirely up to BG. It's between the two of them. So you have somebody else that's able to. Cheniere can take advantage of it themselves if it's in the money and the shipper chooses for some reason not to take an in-the-money cargo over to, wherever. So another question regarding the time lag in price to production response. Can you speak to the October producer-induced throttling back in Pennsylvania and Ohio and the subsequent return of flows? So, one of the things we do look at, and you do see a clear sensitivity of if you just look at production in the Northeast and you compare it to, say, a Dominion, for example, price, you do see that a significant drop in production when you see significant declines in price. There's a bit of a chicken and the egg that's involved in that kind of analysis. In other words, the causation versus cause and effect. And so one could argue the low price makes the producers shut in the production. One can also argue prices are low because there's nowhere for the gas to go and storage is full and the producers are being forced to shut in production and there's excess gas that can't get out. It's hard to sort of say that, which is causing the other. But that being said, you do see that happen whenever there are constraints, the prices are low. And do the low prices cause the constraints, or do the constraints cause the low prices? I tend to be in the camp of the constraint causes the low prices. But you can certainly argue it either way, and I'm certainly not going to spend time sort of arguing that point. But what you should see is for two things. One is that we do have incremental capacity that is scheduled to come online very soon. We have 800 million a day of a REX backhaul project that is due online in December. We have that phasing in over a couple of months. We don't think it fills up day one because we think they're going to take their time. It's taking something that's already a very high pressure pipeline and taking it to, I'm not sure if we've ever seen pipeline pressures that are going to be as high as what this new souped up REX backhaul is going to look like. So in order to not sort of have a catastrophic failure of the pipeline, they're going to ramp that up slowly and make sure that the system can kind of handle it. In addition to that, the other thing that impacts Northeast production is local demand, and it's not entirely a function of always just takeaway. And so if you have local demand growth, and as we mentioned at the beginning of the demand presentation, residential and commercial demand is driven by HDDs, and so it's been a very mild start to the winter. Once you start to get more HDDs in the Northeast, it'll actually enable, you'll get more demand, and that will enable more production. So you'll see this sort of simultaneous thing in the Northeast specifically. When demand starts to increase, you'll get past a place where you're suddenly, because you have better local demand, that export constraint will go away for a time, and so the cash price will suddenly be much better in the Northeast, and at the same time you'll see the production, or the production tick up to sort of because it's enabled to, because you have local demand that can burn it, if you will. And so it's a bit of a lot of it will depend on not only these export projects, but the arrival of winter, which inevitably will happen. It may be a milder than normal winter all winter long, but December is going to be colder than November, and you have more demand in December and in January than we're having now. And so those localized prices should look quite a bit better versus the hub when you get into sort of the peak cold months. We have just a few more minutes. Let's see. I already answered March 17. I don't have a forecast for December HDDs. I assume normals. I'm not a Met. Do we see an uptick in production this winter, and by how much? So yes, we are modeling an uptick from here. Production is definitely constrained. Not only do we see production uptick this winter, we see production growth in 2017 versus 2016, but it's small, very small sort of production growth numbers heading into 17 versus 16. And let's see, how much do you see Rescom sector growing this winter from last year? So that ultimately depends. We have quite a bit of growth baked in because we're assuming a normal winter, even though every day that the forecast keeps coming in mild, we're sort of assuming normal beyond the near-term forecast. Before we started the winter, it was maybe like a 5 BCF a day type number that we were expecting, but now we're getting already through November and it's quite mild, and so that's getting reduced every single day that the weather forecast comes in mild to expectations. But ultimately, it depends on, like we started out the presentation, it depends on the degree days that we accumulate. It's really the main thing. There is some growth in it's a good point to mention this right here. Residential commercial demand is growing structurally. What I mean by that is there's more demand on the residential and commercial side per HDD every year for the last several years, and it's a function of either population or square footage growth on the commercial side in parts of the country, or in the case of the Northeast, people switching from fuel oil as a source of heating to natural gas as a source of home heating. So you are getting growth per degree day, but the main thing still that drives RNC demand is really how many HDDs are we going to accumulate. And here is a question: what does in practice storage containment mean, and where do you see storage containment possibly pushing cash prices in the front of the strip? So storage containment means what we've been seeing right now in the markets. This is a classic example of it when storage is close to full, and you're still trying to inject, essentially. And so because we're having such mild weather through October and then continuing into November, it is causing us to inject quite a bit more than we normally would have in October, and we're injecting further into November than we normally would have. And so that's pushing balances overall up. There's less room to inject. And so, the adage is it has to be burnt or stored. And so sort of two things happen. As you as you're running out of room, that those last available BCF of room that's in the storage system starts to become more scarce. So you're bidding for more and more increasingly scarce storage space. So you're having to put increasing contango in the curve, take the front down versus the back, even by increasing amounts to incentivize someone to fire their last bullets, if you will. Like we used to talk about storage as having so many bullets left to fire, because storage is unlike transportation, for example. Transportation and power plants are every single day you can turn it off or on, and that day's gone forever. Storage is the kind of thing where as you use it, you lose it. As you inject, you have that much room less to inject. And so as you get full, your storage economic models start to require you to require more and more of an economic incentive to fire your last injection bullets. If you only have 1 day left to inject, you might get a little greedy and be like, well, you know what, I'm going to wait and see what cash is like this weekend when it might really be bad. And so that's what in practice tends to happen. And it's what we see happening in the cash markets now. The other thing that happens besides sort of bidding for scarce storage space is that you can take price down to get those supply and demand responses that can help clean up the extra gas in the market. So as you take price lower, clearly you get more demand in terms of fuel switching, and at some level you can start to get price-related shut-ins outside of the Northeast. If you can take the Henry Hub price down sort of low enough, you can get some gas that gets shut in Texas and Oklahoma and various places. So those are other means by which you can sort of clean up the excess gas in the short run quickly, but you have to take price down to do all of those things. Let's see, what else? So the impacts of increased activism and opposition to gas pipelines. That is, for anybody that has particular questions on the projects themselves, we have a team led by Colette Brashears, a team of 3 people that focus on infrastructure, and they are people that you should contact and follow up with, because they're very good and they spend a lot of time, and there's a lot of projects out there. And there are lots of issues that relate to these projects and their timing. The activism is one of them. The FERC process just in general is one of them. Rover, I mentioned earlier, it has its own even further set of issues with one of its major shippers potentially being troubled from a financial perspective. And so there's all kinds of things that can and do impact the timing of pipeline projects, and it can be very complex. And getting into the details of what are the risks to this project getting done on time, and when do we really think it's likely to be online, or what's the range of times, and those are things that our infrastructure team spends 100% of their time looking at, and they are a very great resource, and I would recommend, if you have further questions on infrastructure, to reach out to them. I think that should be our last question. It's nearly 2 o'clock, and I don't think I'd have time to finish any more questions. So I'll say thank you all very much for joining today's call. If I didn't get to your question, we'll attempt to sort of answer it after the fact, and I hope it was enjoyable to everyone. Thank you so much.